Hello and welcome back to the Market Lens. Summer is in full swing and I hope everyone has fantastic July 4th plans. I'm Sam Rozzi, manager of Due Diligence, and I'm joined by Cliff Walsh, American Portfolio's Chief Investment Officer. We are now on the 8th edition of the Market Lens. If you've missed any prior episodes, please check them out on Studio 454 or YouTube. We will start the show by digging into recent volatility in equity and fixed income markets after the latest Fed meeting. Many thought Powell had a hawkish tone, and that caused financial markets to react to the higher likelihood of rates moving up in the next few years. Do you believe rising rates are news or noise?
I think it's noise. Let me just summarize some of the changes on the margin that we saw out of the Fed. 13 of 18 Fed members see at least one rate hike by the end of 2023, which is up from 7, and 11 see 2 hikes. Jerome Powell says his own dot plot shows a first hike in the latter half of 2022. This is on the heels of inflation data coming in hotter than expected, at least according to their forecasts. Now, you and I have been following the Fed together for the past 5 years. You're almost a grizzled veteran. What's the one thing you've learned about the Fed dot plot?
Yeah, that it's rarely correlated to what the Fed is actually going to do. A great example of this is how the COVID crisis stopped the Fed in its tracks from normalizing rates.
Right. The dot plot is not very accurate in terms of its predictive power. The Fed can say all they want about tightening, but it's all data dependent. Powell's own dot plot calls for a hike at the end of 2022, although the broader Fed starts in 2023. Nobody has any idea what the economy will look like at that point. To take the Fed's predictions 18 months ahead when the economy hasn't even right-sized yet is probably not the best way to approach. To be honest with you, I'm not even sure the Fed can raise rates in 2023. It's hard for anyone to predict out that far, but when I look at the state of the economy, certainly not structurally stronger or healthier than prior to the pandemic. Despite the strong current economic data, we are more dependent than ever on the Fed and the government propping things up. Technological advancements and demographics are still very deflationary. And bonus point, Sam, what have we learned about the federal government?
Regardless of who's in power, they can't stop spending and inflating the federal balance sheet.
Exactly. $28 trillion in debt, much of it short term. All of the new debt in the last 15 months has been interest free. Every 25 basis point interest rate hike boosts interest payments by $10 billion. And we won't even talk about the effect of higher interest rates on the housing market, corporate debt markets, and even the consumer debt markets. The Fed is in a very tough spot when time comes to raise interest rates. There are going to be significant negative effects. The good news is that we think inflation will normalize in the next few months and the Fed won't have to act.
So how trustworthy do you think the Fed is in regard to their tapering comments?
I think that we can take the Fed more at its word about tapering of the balance sheet because there are fewer strings attached. My sense is that even tapering is going to be a problem, which will ultimately keep the Fed from raising rates anytime soon. Even if it goes surprisingly well, a very small probability, the Fed will take its time on seeing how it all plays out. Given how bloated the Fed balance sheet is now, doubling to $8 trillion in the last 18 months, it took 11 years to add the previous $3 trillion. There's a lot to consider before we worry about the dot plot.
Yeah, thank you for your comments on the Fed. Let's shift gears and zoom in on the energy and oil markets. It's been one of the few bright spots in the commodity space this month as the broader group has pulled back significantly from recent highs. We're seeing highest gas prices at the pump since 2014. Is this going to be a problem for the U.S. economic recovery?
I don't think so. There's talk of $100 oil, but I don't typically put too much stock in talking head predictions. That would obviously put a damper on disposable income. The consumer is in decent shape coming out of this recession as government support actually boosted personal income despite the massive surge in unemployment. So there is some dry powder. But if we hit that and it was persistent, it would definitely be an issue. $100 oil equates to about $3.50, $4 a gallon for gasoline. A spike in oil and gas prices is a common occurrence prior to recessions. We saw prices over $4 right before the great financial crisis. I don't think we're getting back to $100 oil anytime soon. But if we did, I laid out the case for you. Here's why I don't think we're getting back to there. Higher prices attract increases in U.S. shale production. OPEC might move to increase production before that, wanting to get the extra volume rather than allowing the U.S. to take it. So that's a likely lid on prices. There are already production increases in the works as OPEC ramps back up after last year's pullback.
So what about the dollar? Do you think it can or will impact oil prices?
I think it's a potentially large impact. The U.S. dollar, which has been languishing for years, is starting to show some life. It recently formed a triple bottom and broke above its 200-day moving average on the heels of the last Fed meeting. So it could have some legs, which would put pressure on oil prices. So far, it's not, a runaway breakout, but I do think that the move higher is significant from a technical and psychological standpoint. it's another potential headwind for oil prices. And if we're wrong and the dollar doesn't go higher, I think it's a solid floor that's been established, so the wind won't be at oil's back.
And what about energy equities? Do you think they can continue to run?
A great place to be this year. I think the sector is up about 40%. Production is returning. It's hard to specify a bottom in crude prices last year as futures contracts went negative, but let's exclude the shutdown and look more recently at the November bottom when the economy was starting to reopen. Prices have doubled since then. It's been a huge driver behind the equities move higher. Again, probably unlikely to be a huge catalyst higher going forward, as we're not expecting oil to break out higher. And looking at the broader commodity complex, which has seen double-digit price retreats, if not as much as 50% in some instances, it might make some sense to take some profit in energy equities at this point and look for something a little less volatile and economically sensitive.
Thank you for your wide-ranging comments today, Cliff, and thank you to everyone who joined. Enjoy your July 4th weekend, and don't forget to apply your sunscreen, especially you, Ed Levine. I hope this market lens is letting you see 2020. Have a great day.